I request our member CA Nagaraj to welcome today's interesting program on overview of US tax regulations as applicable to individuals, covering FTC and other subjects. To handle this session, we have an eminent speaker, none other than CA Amarnath Ambati. I request our member CA Nagaraj to welcome the speaker with bouquet. Thank you, Mr. Nagaraj.
Thank you, Srinivas.
Yeah, it's a very interesting subject. Very few people practice in US international taxation. In that, Amar Ambati also is one, is worked in E&Y, has got a lot of experience in international taxation. He has agreed to come and address our members. I thank Amarnath and welcome you all once again. I request our committee member Shripad to give a brief introduction of the speaker. Over to Shripad.
Yes, thank you, Chairman sir. It is my pleasure to introduce today's speaker, CA Amarnath Ambati. CA Amarnath is practicing. He has over 18 years of experience in the field of expatriate taxation and tax consulting. He started his career in KPMG US, where he worked on US tax returns and related compliance for expatriates. The international tax practice of Deloitte Bangalore. His expertise includes various facets of global mobility like NRI taxation, US tax, totalization agreements, international work through NASSCOM in matters concerning social security legislations. So with this brief introduction, I would like to again welcome CA Amarnath Ambati. Over to you, sir.
Okay, thank you, Shripad, and thank you, Bangalore branch. Good evening, everyone, and I would like to thank the Bangalore branch of ICAI for giving me an opportunity to come and speak on US tax matters, specifically applicable to individuals. And I would also like to extend my warm welcome and my sincere thanks to all the participants who have made up their time to attend this session. So coming to the today's topic, as mentioned by Sripad, it is US tax regulation, overview of US tax regulation as applicable to individuals. Let me share my screen now. Is it visible? Yeah. So coming to the overview of US tax regulation for individuals, I would like to cover the important topics as applicable to individuals in today's session. As everyone may be knowing that US tax regulations are also very vast, and a deep analysis are required to understand these regulations in detail. However, to the extent possible, I'll try to cover. If you guys have any questions at any point in time, please feel to raise those questions. Also, US tax has very unique features compared to India. We have only residential status. However, US tax has residential status as well as filing status as well. And in India, we do not have any state or city taxes. But in US, even states levy income tax. Most of the states levy income tax, and some cities also levy income tax, apart from the property tax what we pay. So there are some more unique features of US tax which we are going to discuss in detail in the coming slides. So coming back to today's session, the contents, basically the basics, which covers the residential status and scope of income liable to tax, and the filing status, what we discussed, the unique feature. These are all covered in basics. And taxability of certain incomes, like what we have, that 5 heads of income. Similar to that, even US has certain heads of income. As everyone know, there is a residual income even in US, other income, all other income is clubbed in one residuary head. So we'll discuss all those heads of income. Then double taxation relief. When it comes to double taxation relief, we remember only DTAA and as per India income tax. But however, for double taxation relief, US has certain provisions in its own domestic tax laws. So everyone should go by that rather than getting into the treaty. Then compliances. There are a host of compliances required from US perspective. It is just not filing 1040 or 1040 NR income tax return. They do have other filing requirements like I-10, W8, BEN or F-bar reporting, foreign asset reporting. All these are other forms which are required provided certain conditions are applicable or certain conditions are satisfied by the taxpayer. Then coming to challenges, what are the challenges from India perspective? When I look into US tax return, there could be a lot of challenges or a lot of complications involved where I need to understand the US return in order to avail the FTC or in order to report the US income in India tax return. So let us see what are the couple of challenges, what we come across practically while looking at US tax return. Then understanding the US tax return at a high level for the purpose of India taxes again. If you are claiming an FTC in the India tax return, how would you look at the US tax return and what numbers you need to take? What are the taxable incomes or tax rates? I mean, are there any special rates applicable? How to deal with those things? Also, we will see here. And then not last but not the least is the opportunities for a practicing CA. I don't promise there are good opportunities here. However, if you have any clients where you are working for a US citizen or you are providing some information to your clients CPA in US, just see whether there are any opportunities where we can convert that as a billable engagement rather than giving it for free. So coming to basics. First comes the residential status. I mean, residential status for an individual in India is so complicated that we will go for go to prior years and see for his stay details for 7 years, 10 years, all that. But US does not seem to be that complicated. But when you look at the types of residential statuses, there are certain unique features in this. So under residential status, there are two tests to be looked into. One is green card test. If he is not satisfying the green card test, then you will come to substantial presence test. So under green card test, if the person is holding the green card, he is a resident of US. Irrespective of the number of days he has stayed in US, it could be 0 days. He must be living in India or somewhere else, but he does not have any days in India, but he is a green card holder. He is a citizen, he is a resident of US for income tax purposes. So global income is taxable for him. So suppose what happens, I'm not a US resident and I've never been to US. So, but I have received the green card on June 1st, 2022. So am I a resident of US? Yes, you are a resident of US from June 1st, 2022 onwards, from the date of, that is from the date of receipt of the green card. So similarly, if I surrender the green card, what happens? There, of course, there are the implications are very harsh at the time of surrendering of the green card. But anyway, yes, the residency terminates on the date of surrender of the green card. Then comes the substantial presence test. So many people who move for employment purposes or through the company, it could be on a work permit or from the company side, intra-company transfers. Generally, we look into substantial presence test. Many people may not be having the green card at the time of their move. So under substantial presence test, you need to look into the number of days presence. We will get into the number of days presence under this test. So what are the conditions for the number of days presence? That is 31 days in the current year. A minimum of 31 days should be present in US to become a resident in the current year. And 1/3 of prior year days and 1/6 of prior to prior year. Which means to say that I will look into the current year plus 2 preceding years to see whether the person qualifies for a resident or not. So all these three things, that is current year days plus 1/3 of prior year days and 1/6 of prior to prior year days, if you add up and if you the total number of days is 183 or more, then the person is a resident of US. He may be staying in US from past 5 years, but he has left US as on 30th January 2022. So is for 2022, is he a resident of US? No. He might be staying for the full prior year or prior to prior year. Since the number of days stayed in the current year is less than 31, he is not a resident of US. And US follows calendar year for tax purposes, which is Jan to December. We follow April to March. So that's the one difference which we have when it compared to India and US. So then how do you determine US residency in the case of a first year of arrival or year of departure under substantial presence test? Taking my example, the person is not a green card holder, but he has gone to US on June 1st, 2022. Let's take an example. So from June 1st, 2022 onwards, he is in US and he has never been to US in his lifetime. Whether he is a resident of US, 31 days in the current year. Yes, he has 31 days in the current year. 1/3 of prior year days, 0. 1/6 of prior year, 0. But in the current year, how many he has? Total of those days comes to almost 200 plus. So he will be a resident of US. So what is his residency start date? So in India, see, when we say determine the residential status, and if he is a resident, we consider him for a resident for the whole year, right? So here it is not like that. So it's an optional for residents to claim the dual status resident status, which means to say that in the year of arrival, the residency start date is the first day of arrival to US. In my example, it is 1st June 2022 to 31st December 2022. He is a resident, but he is not a full year resident, but he is a dual status resident. What is dual status resident? It is just a part year resident. For part of the year, he is a resident, and in the same year, he has two statuses. One is resident, the other one is non-resident. What is non-resident period? From 1st Jan to 31st May, he has no days in US. He has never arrived to US. So that period is considered as a non-residency period. So he has two statuses in the same year. So he is called a dual status resident. And then the next thing is non-resident. In my first example, where the person has departed on 30th January, so he is not having 31 days in the current year. So he becomes a non-resident of US. So full year resident, part year resident or dual status resident. Then the third category is non-resident status, non-resident US person. So then coming to citizens, again, as we discussed for green card, US citizens are always US residents for tax purposes. It doesn't matter where they are living, whether it is 0 days presence in US also makes them a resident of US, and global income is taxable in US. So there could be many situations where the person is a US citizen, but he is a resident in India. You also may be having those kind of clients. So India also taxing global income, US is also taxing global income. So yes, you can avoid the double taxation, and we will see double taxation mitigation strategies in the further slides. And then coming to residency termination date, similar to arrival, let us take an example. He terminated the residency on July 31st. The person departed from US and later on he did not go to US at all. By default, the residency termination date takes into the last day of the year, which is 31st December. However, by proving that he does not have any connections to US post his departure, in my example, he can make the residency termination date as 31st July and offer global income to tax only till 31st July. Post that, he can claim a non-resident status. Again, dual status resident at the time of, in the year of departure as well. So there is a concept of elections. Of course, we will discuss those elections in detail in further slides. So by making elections, you can make a dual status resident as a full year resident because of the availability of filing status, as you can file a married filing joint status for him, which are more beneficial tax rates compared to other filing status. So every year when the return is prepared, we have to see whether dual status is beneficial for that person or full year resident is beneficial for that person, and accordingly take a call on that. So scope of income liable to tax, basically income accrued or arise in India, what we have, section 9, similar to that here. So resident global income is taxable, non-resident global income is not taxable, only US source income is taxable. However, dual status, again a unique status. So he has two residential status, non-residency period and residency period. For non-residency period, only US source income is taxable, whereas for residency period, global income is taxable. Then comes the filing status. So we have seen residential status now, and we do not have a concept of filing status in India. Filing status here means for an individual, whether he is a non-resident or resident, he can choose one of the filing statuses which is given here, that is single, married filing joint. Married filing joint can be taken only for a married person, and a married filing separate. Even though he is married, he can go for separate returns depending on tax rates and his income. Whichever is more beneficial, he can choose that. Then head of household. Head of household is basically written where you will file as you are the head of the family. Then qualifying widower, this option is available only for a widower having a dependent child. So these are the 5 different filing statuses. So what is the use of this filing status? Why do I need to look into filing status while filing the return? The tax rates are dependent on the filing status you choose to file the tax return. Just taking a married filing joint, which is the most beneficial when it comes to tax rates, provided the conditions have to be satisfied. A single person cannot file a married filing joint at all at any point in time. So as on 31st December, the person has to be married for him to go for the selection of the married filing joint return. Married filing separate, generally married filing joint is more beneficial. So very rarely we will see married filing separate returns. Generally people who are in the process of separation may file a married filing separate return. As on December 31st, if the person is already separated or legally divorced, then he has to file a single return and not married filing joint or married filing separate. Divorcee will be considered as not married. So he will, he will qualify as single only. Then comes the tax rates. As I mentioned, married filing joint gives the most beneficial tax rate. Slab rates are starting from 10% to 37%. The maximum marginal rate in US is 37%. And apart from this, there is a investment tax as well, which goes up to 3.8%. That is only for the passive income if you have any investment income. So the maximum marginal rate for certain types of income may go up to 40.8%. And there's no basic exemption limit. Like in India, we have 2,50,000 or 3 lakhs was depending on the person. There is no basic exemption. And again, special rates may apply to certain categories of income. We will see what are those income. In India, we do have a special rate applicable for long-term capital gain. Similarly, even US has a special rates for long-term capital gain. And there are a couple more incomes where we come across generally where special rates are applicable. Again, though dual status or non-residents, though they are married, they cannot opt for married filing joint. They have to file married filing separate returns only. Even though they are married. If they are unmarried, they have to file it as a single return. So scope of tax planning by making elections. So why do we make elections? Why do we make non-resident as a resident or dual status as a full year resident? Because they can go for married filing joint status, which is more beneficial. So we will see the elections if that is possible, and if we meet certain conditions. One condition is in the coming year, in the subsequent year, he should be staying in US for 183 days. That's one of the conditions for elections. And the other condition is both husband and wife should be US resident at the end of the year. The other election example is only one person has to be resident at the end of the year. So depending on the client's situation, you have to see which is more beneficial and make that relevant elections. And before making elections, first you should see whether married filing joint or filing a full year return is more beneficial for him. So you have to compute the taxes, assuming he is a full year resident, also as a dual status resident and a non-resident return. So in all the 3 options, whichever is more beneficial, we will decide to go for that. That is one tax planning aspect which is available from US tax perspective. Then comes the heads of income. So first is the wages and salaries. Even we have salaries in India. So even they have wages and salaries. Any remuneration, whatever you earn from your employer by whatever name called, is taxable as wages and salaries. It could be bonus, it could be 401k employer contributions. Of course, there's a specific exemption for that. So anything which is getting from your employer, it could be like a lump sum payment or incentive or tips, everything is taxable under wages and salaries. And the form which is issued for wages and salaries is W2, which is similar to Form 16 in India. So an annual reporting statement called W2 will be issued by employer, and based on that, the employee has to report the wages in his tax return. And similarly, a same form, a copy of that will be filed with IRS as well by employer, and that's how the IRS cross verifies whether the salary income has been disclosed properly or not by the individual. Then comes interest. Interest is another head altogether. There's a separate line item in the tax return for interest. This includes even tax exempt interest. In the same line, you have to disclose what is tax exempt interest you have received during the year, if there is anything, and also the taxable interest. Then dividends. We will look into dividends in detail in the coming slide. There are two different types of dividends, actually, ordinary dividends and qualified dividends. Both need to be reported in the tax return. Then comes pensions and annuities, is a separate head of income. Then capital gains, similar to India, capital gains is little complicated in US as well. Then all other income comes under additional income category, which includes business, profession, rental income, royalties, K1s. K1s are partnership incomes, then farm income, alimony received, anything and everything will come as additional income. There will be a separate schedules for all these incomes. Each and every schedule deals with one kind of income. So if you have that particular income, you need to fill that schedule and the amount needs to be taken to the face of the tax return. Certain categories of income, let us have a deeper discussion to understand it in a better way. So dividends. Dividends is one such unique thing in US. So ordinary dividends. Ordinary dividends are taxable at normal rates. And when you look at the reporting purposes, there will be a separate column for ordinary dividends and qualified dividends. The form which will be issued by the payer of the dividend is 1099 DIV, which is similar to Form 16A here. So under 1099 DIV or 1099B, consolidated statement of all passive income, interest, dividend, and capital gains income. So there the employer will report separately ordinary dividends and qualified dividends. Qualified dividends are taxable at special rates. FTC is also available in India at special rates only. So this is one point which you need to keep in mind when you are claiming an FTC for a US person in India if he has a qualified dividend. So what is the speciality of qualified dividend? The payer will determine whether it is an ordinary dividend or a qualified dividend depending on the number of days the stock has been held by the individual. So if the stock is held by 61 days out of 120 days prior to the date of X dividend date, then it is a qualified dividend. Of course, we need not determine that. As I mentioned, the payer of the dividend will bifurcate that and gives it to you. So you can just look at 1099 dividend and report this appropriately in the tax return. In tax return, again, there will be two columns, one for ordinary dividend and qualified dividend. But in 1099 DIV, one catches ordinary dividend includes qualified dividend. Say suppose ordinary dividend is $1,000 and qualified dividends are reported as $500. It's not 1,000 plus 500. 1,000 includes 500 of qualified dividend. So while reporting in the tax return, you report ordinary dividends also as there also the reporting goes 1,000 plus 500 only, but the software will calculate the tax accordingly. While calculating the tax on ordinary dividend, it eliminates the qualified dividends of 500, then it calculates tax only on $500. So what are the beneficial rates which are applicable for qualified dividends? So if your normal income or I would say all other income excluding qualified dividends falls under the tax bracket of 10 to 15%, then qualified dividends are taxable at 0%. There's no tax on qualified dividend. If your normal income excluding all other income excluding qualified dividends is taxable between more than 15% or up to 35% tax rate, then qualified dividends are taxable at 15%. If your ordinary income excluding qualified dividends are taxable at 37%, then qualified dividends are taxable at 20%. So the maximum rate which is applicable for qualified dividends is only 20%. So by applying the average rate, if I'm claiming the FTC, then that may go as a wrong because I'll apply the average rate may come to around 35% or 30% depending on the taxable income. But whereas this is taxed at a very lower rate of 15% or 20%, and sometimes it is zero rate as well. So be careful with while claiming FTC on India tax return on these kind of dividends. Then comes the capital gains. So capital gains is very interesting from US perspective as well. So even they have short term and long term, but for short term, the holding period should be less than or equal to 1 year. Irrespective of the kind of asset, whether it is a real property or shares or mutual funds or any other investments or lands or bullion or jewelry or whatever asset it is. So if the holding period is less than or equal to 1 year, it is short term. So if it is more than 1 year, then it is long term. No indexation benefit is available. Straight away, the purchase price need to be deducted from the sale price and you have to calculate the taxes. Short-term gains are taxed at the normal rate, which is it goes as a normal income, so it is taxed at the applicable slab rates. Whereas long-term capital gains are taxed at special rates, and whatever rates we saw for our qualified dividends, that is 0%, 15%, 20%, they are equally applicable for long-term capital gains as well. And whenever you see these 1099-B, the US documents, there may be one other item called capital gain distributions. So what are these? These are basically mutual funds. Whatever, if you have invested in the mutual fund, in India, what happens if the mutual fund has a capital gain or it is dividend income, we will not get to know. They will distribute the income as dividend only. But in US, if the mutual fund has a capital gain, they have to distribute that as capital gain distributions. Only dividend income will be distributed as dividend, whereas capital gain will be distributed as capital gain distributions. Again, these capital gain distributions are considered as long term. Always capital gain distributions are long term, and how it is being calculated by the mutual fund house, that doesn't matter for us. So mutual fund house, while giving the form, they specifically say that this is the capital gain distribution amount and this is the dividend amount. So if it is a capital gain distribution, that is taxable as long term capital gain for US tax purposes, and again special rates are applicable for that. So capital losses, if there is a loss, what happens? Definitely you can offset with the capital gain. There is no limit for offset, and it can be carried over for indefinite period. Whereas in India, it's only 8 years, but whereas in US, can be carried over for indefinite period. Then can I set off with the other head of income? Yes, definitely you can set off with intra-head set off. No limits. Within capital gains, there is no limit. However, inter-head, if you want to offset with any other income, yes, definitely possible. And the maximum available is if you're filing married filing joint, it is $3,000. Married filing separate, $1,500. And it is not that only in the first year you will be able to set off with other income. Every year you will be able to set off with other income. You can carry over the losses, and to the extent of $3,000, you can offset with other income, even though you do not have any capital gains during that year. So that is another feature which is given in the US taxation. So gain from sale of principal residence. Principal residence here means basically the home which you are using for your own purpose, or where the home where you are living. So the gain arising from the sale of principal residence is exempt to the extent of $500,000 if you are filing married filing joint. And if you are filing married filing separate, then it is $250,000, 50% of this. And certain conditions have to be met, of course. So you should have used that house as your primary residence in 2 out of 5 prior years prior to the date of sale. So these are the couple of conditions which are available, and the property should be situated in US. It's not available for the foreign property. And once you satisfy all those conditions, the gains will be to the extent of $500,000 or $250,000. It is completely exempt. Then comes rental income, royalties, and partnership income. So there's a separate schedule called Schedule E, which you need to report these incomes. And for capital gains, it is Schedule D. For dividends, it is Schedule B. So rental income in India, unlike we have this standard deduction for the 30% for repairs and maintenance or any other things, we do not have such standard deduction in US. However, actual expenses can be claimed as a deduction from the rental income. And there is no limit on actual expenses. Actual expenses includes your mortgage interest as well as your property taxes. And in US, unlike India, property taxes will be huge. I mean, which may go up to $15,000, $20,000 per annum. So entire property taxes can be deducted from the rental income. And if you are letting out the property from the rental income, not only this, you can also treat the property as a business asset and you can avail depreciation benefit. Rather, I would say that it is mandatory to avail the depreciation benefit when you are letting out the property. There is different way of calculating the depreciation. The rates are prescribed, and depending on that, yes, you can avail the depreciation benefit. However, on land, it is not available. Only on the building or any other improvements you have made for the property. On all those things, the depreciation is available. And what happens when I sell this property? What happens to the depreciation? At that time, depreciation will be recaptured. Entire depreciation amount will be taxable in the year of sale, but it is taxed at a reduced rate. So it will be completely recaptured. Sometimes you might have seen unrecaptured section 1250 gain, which is nothing but a depreciation on the let out properties. It is taxable in the year of sale. Then comes the partnership income. Partnership income in India, we tax the partnership income at the partner level, and the share of profit whatever received in India is completely exempt. So in US, it is not like that. In US, partnership will be treated as a pass-through entity, which means to say that it is just adding as an intermediary for the partner to receive that income. So it will not pay any tax and no income is taxable in the hands of the partnership person. So partnership will distribute the income to the partners depending on their share of income. And the report is called K1 report. Every partnership or an S corp or a trust has to issue K1 to the partner or a member. So based on that, they will allocate the, in K1, they report the share of income for that particular individual. So based on the K1, you have to report the incomes, various incomes the firm has got into the individual tax return. And again, one more complication here is if the US citizen is a partner in an Indian partnership, how will you treat that? Can we treat that as a pass-through, or Indian partnerships, we never treat that as a pass-through. But for US purposes, what will you do? US purposes, there are the ideal way is to treat that as a pass-through and determine the income or share of all the incomes whatever the partnership firm has received during the year to that partner, and so that that partner can report it in the US tax return. A specific form has been prescribed for that, that is Foreign Partnerships 8865, which is nothing but a K1. All incomes need to be reported in 8865 to the extent of partner's share. So that the partner will report that in his return. 8865 also need to be filed along with the income tax return, which is 1040 or 1040 NR. Stock options, very similar to India. The provisions are very similar. So at the time of grant or vesting, no tax impact. On the exercise, yes, there is a taxable benefit. Fair market value of the stock will be determined as on the date of exercise. And the difference between the fair market value and the price paid by the employee will be considered as a perquisite, which goes as a salary income, even in US. But in case of RSUs, what happens? Vesting coincide with exercise. It will be on the same day. So in case of RSUs, we typically say that it is the vesting date which is more important, not the exercise date. So for RSUs, it is the vesting date. For other than RSU, it is the date of exercise, and the perquisite value will be reported in W2 and goes as a salary income. And what happens at the time of sale? The perquisite value, I will consider it as a cost, and the difference between sale price and the perquisite value is the capital gain. There's no question of indexation for US purposes, US tax purposes. So it is the absolute gain, whatever you get is taxable as capital gains. And the holding period, again, from the date of exercise is, we will see, to the date of sale. If it is more than 1 year, it is long term. Less than 1 year, it is short term. And in India, recently the tax laws got amended. 80 EAC benefit for startups where they can defer the stock options. A similar benefit is there. There is no distinction between startup or a normal company. The separate stock option category called ISOs, incentive stock options. And if the incentive stock options are allotted to the employee at the time of exercise, there are no tax consequences. The taxability of the gain is deferred to the time of sale of those stock, and the entire gain between the sale price minus the price paid by the employee, that entire spread will be taxable as capital gain at a lower rate. That is one beneficial treatment what the US law has given for only incentive stock options. So there are also certain unique features in US tax law. One is citizenship, taxation based on citizenship. I'm not very sure whether any other country in this world has this kind of a citizenship taxation. So if you are a US citizen, you will be taxed on the global income, irrespective of the number of days you are present in the US. No, without any exception. There is no exception to this rule at all. Then comes itemized deduction versus standard deduction. So in India, we have standard deduction only for salaried employees to the extent of 50,000. Otherwise, it's all deduction under Chapter 6A for us. It is more like an itemized deduction. Different deductions I will take and I will claim that in the tax return if I'm eligible. But in US has a given as an option to individual to claim itemized deduction or standard deduction. Standard deduction, if you're filing married filing joint, is $24,800 for the year for an individual. If you're filing married filing joint, but if it is married filing separate, there's 50% of it, 12,400. You can optimize between itemized deduction and standard deduction. This standard deduction is not only for salaries, it is on the entire income in US. All the income will be aggregated and you can claim a standard deduction from that income. Then another unique feature is state tax return. So state tax return, states have a separate authority to levy the income tax on the income if the person is a state resident. Again, the residency rules between states and federal may vary depending on the state. California and New York has separate residency rules. California says if you are a domicile, not only a green card holder or citizen, but if you are a domicile of California state, then you are taxable on the income in California. So similarly, they do have non-resident status, partier state also you have. If a person is moving from one state to another state during the year, so again, there could be a partier resident state returns you may have to prepare for both the states. So 2 states and 1 city or 2 cities depending on the city where the taxpayer is living in, you have to file the returns. There are 6 states in US which exempts the person from the income tax. That is Washington, then Florida, then Texas. These are a couple of states where there is no income taxes, and so there is no income tax consequences if you are living in those states. You will pay only federal income taxes. Then comes the city return. New York City, apart from federal and New York State, New York City also levies taxes, income taxes, and Pennsylvania is another state where each and every local authority levies income tax on the person. So you can imagine, see the maximum marginal rate we saw 37 plus 3.8% of investment income 40.8%, and in New York and California the tax rates are 12% state return, and city return also New York City levies 4%. So the maximum rate is for a person who is earning more than $500,000 in a year may go up to 55% or 56% depending on the state or city where he is living in. So another important clause or a unique feature of the US thing is if you see any of the US treaties, there will be a saving clause in the treaty. Even when you look into India and US double taxation avoidance agreement, there is a saving clause. What it says is, notwithstanding any provision of the convention except paragraph 4, which is residency, a contracting state may tax its residents and by reason of citizenship may tax its citizens as if the convention had not come into effect, which means that their domestic tax law overrides the treaties if the person is a resident or a citizen of US. In India, double taxation relief means the moment we look at double taxation, we get into the DTAA or tax treaty. Also, tax treaty provisions will override the Income Tax Act in India. But US, if you see US treaties, this clause will be there. So for residents and citizens, domestic tax law overrides the treaty for most of the clauses. Very few clauses in the treaty they can avail the benefit. But whereas for a non-resident, entire treaty provisions are applicable. So we saw that, for double taxation relief, the US citizens or residents, they cannot avail the benefit as per treaty. There is a saving clause in the treaty. So what are the other benefits available? How do they mitigate double taxation? So before getting into double taxation relief, I just want to touch upon the sourcing rules. Sourcing rules are again very different for capital gains, but others more or less, which is similar to other countries. So salaries and wages are place where employment is exercised, that is physical presence. If a US citizen is sitting in India and working in India, though it is taxable in US, but it is considered as an India source income. So US provides FTC for that income, double taxation relief for that income, because it is not a US source income. So place of employment where employment is exercised is the place, or is the place for determining the source of the income. So if the person is sitting in UK and rendering services as an employee, it is UK source income and not US. He may be on the payroll of US. US employer may issue a W2, but still coming to the sourcing rules, that is UK source and not the US source. So interest and dividends, location of the payer. If the company is situated in US, then it is US source. Or if the bank is situated in US, which is paying interest, that's a US source. If they are situated in another country, then it is foreign source. Capital gains from sale of stocks. See, in India, again, we go by the status of the company for determining capital gain, or if it is a real property where the property is situated. But US has a unique feature of determining the source of capital gains based on the residential status. If you are a US resident, that is US source capital gains, wherever it is arising globally. So if the real property is situated in India, and if the person is a US resident, say suppose he is a US citizen, US says that nevertheless, it doesn't matter, though the property is situated in India, I will consider that as a US source income and tax you on that income. And you might have seen the reverse case, like I have stock options allotted by Microsoft, and there could be crores of gains employees make, Amazon or Microsoft, Google, these employees. They are not residents of US. That's why US does not tax those capital gains at all. Even though they are holding Google US shares, the gains arising from sale of that is not taxable in the US if he is not a resident of US. So the Indian employee, when he is selling those stocks in the US stock market, and all these stocks, Microsoft or Google or Amazon, they are not listed in India, they are US shares and listed in US, but that is not taxable for a non-resident, because the resident sourcing rules are different. That is, since he is a resident of India, that is considered as India source. And when we have seen that for a non-resident, only US source income is taxable. So since that is India source income, that is not taxable in US. So what are the strategies or mitigation strategies for double taxation? US gives one provision in the domestic tax law itself, which is called foreign earned income exclusion. Exclusion is nothing but exemption. The income is straight away exempt provided these conditions are satisfied. No need to add that as income and then claim foreign tax credit. So what are the conditions? He has to be a resident alien or a green card holder or a citizen of US, and the amount it is foreign earned income. Earned income is, basically it is non-passive income. This exemption is available for employment income or self-employed persons if they are exercising their employment abroad, and they are also US citizens or residents of US. So this is an election to be made. It is not mandatory. So if you want to claim foreign tax credit completely, you can claim foreign tax credit. The maximum exemption available under foreign earned income exclusion is $1,12,000, $112,000 for 2022. So say suppose the person has $200,000 as salary income. So can he claim both foreign income exclusion and foreign tax credit? Yes, to the extent of $112,000 he can claim exclusion. The balance $88,000 he can come back to Form 1116, that is foreign tax credit, and claim foreign tax credit. But he cannot claim both the benefits on the entire income. Any one of these benefit has to be claimed for a portion of the income. So this is again, as I said, election to be made, and conditions need to be satisfied. There are two conditions which need to be satisfied to claim this exemption, which goes as physical presence test. PPT, what we call it as, which says that the minimum 330 days he has to stay abroad, that is not in US during the calendar year. So if he is staying 330 days abroad and he has earned income, which is non-passive income, then he can avail this exemption. But for US citizens, other than PPT, there is another test called bona fide residency test. If he proves that he is a bona fide resident of foreign country, then definitely he is eligible for this. So under what circumstances this is beneficial, or why can't I go with the foreign tax credit always? There could be situations where the other country has no tax at all. So tax haven jurisdictions like UAE or certain countries in Dubai region, Gulf region, definitely they take this exemption and they come out of the tax. They need not pay tax anywhere, both in US and the host country or resident country. They will be completely exempt provided they qualify for these exemption. And similarly, foreign tax credit is the another exemption available. So foreign tax credit, again, these provisions are available in domestic tax laws only, not treaty relief. I'm not talking about the treaty relief. This is again a domestic law provision, and Form 1116 need to be filed if you are claiming a foreign tax credit. Again, to be eligible for foreign tax credit, the income has to be from a foreign source. And different baskets of income are available in under 1116. It is passive income or general limitation. So if it is a passive income like interest, dividends, capital gains, all those go as a passive income. And employment income or a self-employment income goes as a general limitation income. So if the person has both the incomes during the year, for each income, there has to be one Form 16 to be filed. So if he has both salary income and interest income from foreign country, and if he is claiming foreign tax credit for both these incomes, he has to file two Form 1116s. One is for passive income, which is interest income. Other one is for salary income. And another unique feature of this foreign tax credit is you can claim based on a cash basis or accrual basis. They call it as paid basis, which means to say that irrespective of when the income has accrued, whether it is in the prior year or in the current year, under paid basis, if I'm taking an example of calendar year 2022, whatever the foreign tax I have paid during 2022, I will claim that as a credit during 2022. Income I may tax pertaining to 2021 or 2022. That doesn't matter. I am claiming on the paid basis. So during the year, whatever taxes I have paid, I will claim. And other thing is the accrual. Accrual is basically accrual method. Whatever the taxes has been accrued during the year, only that I will consider. So from whether I can I change year on year accrual to paid? If you are opting for paid basis of FTC, you can change it to accrual at any point in time. But once you have opted for accrual, you cannot come back to paid. Accrual election is only once in a lifetime. So once you have adopted accrual, you must follow the same for the rest of your life. Then another important feature of FTC is carryover. Like we have seen in India, carryover of losses, but not foreign tax credit. Say, for example, the person is from a high tax jurisdiction like UK, where he has paid taxes at the rate of 46%, whereas in India, I'm going to tax it at 30%. So the credit is available to the extent of lower of these two, which is 30%. The balance 16% is gone. But in US, that 16% or let us say $16, he can carry over and use it for future years if he has any foreign earned income. So how long he can carry over? He can carry over the foreign tax credit for 10 years. Similarly, there is another interesting provision is carry back. So in this year, I have a excess foreign tax credit of $16. Can I carry back? If I have excess foreign source income in the last year, in the prior year, can I carry back and amend that return and claim this return? Claim the credit? Yes, you can do that. And for how many years you can do that? It's only 1 year. So for foreign tax credit, carry back is 1 year and carry forward is 10 years. Very important or a very unique feature, interesting feature in US taxes. So whenever you are preparing the return, whenever we come across with foreign tax credit, we have to see that. Current year, yes, we will determine, we will do everything, but we also need to see prior year if there is any excess credit available in the current year. So I can carry backward and amend the return last year return and claim that refund now. So then comes the taxation of non-residents in US. There are certain topics or certain unique features like what we discussed now for foreign and income exclusion or foreign tax credit. A similar thing is available for in the case of non-residents as well. So non-residents, yes, we have already seen that only US source income is taxable. So I have say suppose I am a non-resident of US, I have US bank interest to the extent of $100. So is that taxable? No, there is a specific provision exemption in the US law for a non-resident. US interest is not taxable, irrespective of the amount. Of course, the banks will not pay interest like India there. I mean, it is even if you see the entire bank statement for the entire year, maybe $1 or $2, maybe the interest what he has received. Even if it is significant amount, it is not taxable for a non-resident. And then coming to dividends. Dividends are generally taxed as per the domestic tax laws. If you are receiving it from the US companies at the rate of 30%, which is effectively connected with the US trade or business. But if there is a treaty between the US and a different country, then treaty rate can be applied. When you look at US and India, the treaty specifies, I think, 25% rate. So for US residents who are non-residents of US, instead of 30%, you can claim 25% as the dividend rate, applicable rate. So treaty rates could be availed. Then capital gains from shares exempt based on the sourcing rules. We already saw that for a non-resident, even though the gain is arising from US share, it is considered as foreign source income because he is a resident of other country. And anyway, for non-resident, only US source income is taxable. The gains are not US source, so that is completely exempt, not taxable. But only for disclosure purposes, you may have to disclose in the 1040 NR. Then student visa. We have seen this J, F or M visa, trainees or students. So they can have the non-resident status for first 5 years of their stay in the US from the date of receiving the visa. So irrespective of whatever we discuss now, substantial presence test, the number of days is not applicable. But for the first 5 years, though they are completely staying in US, though their stay is more than 183 days, they take the filing the status as only non-residents of US. Then generally state or city returns not applicable unless there is a trailing income. See, for a non-resident of US, if I'm not residing in US, so generally I'm not a resident of the state also. So the state returns are not required. However, sometimes what happens is in case of these stock options, if that is being accrued while the person was in US and if it is paid now, then the employer will issue a W-2 for a trailing liability. He will report the income as well as withholdings on the W-2 form. So in those cases, if he has reported state wages, if the person while he was in US, if he has rendered services in a particular state where that income was taxable at that point in time in that particular state, W-2 will indicate that, and so you may have to file a state return as well, though he has not resided in US during that year. And another example is the California, where it taxes the person based on domicile. So if say, for example, if that person was living in California, he has a own house in California, which was not let out. It was available for him at any point in time while he was visiting US. California says you have a domicile here because you have a home here. So please file the tax return considering the income, whatever you have received in California. So a lot of interesting topics or very unique features when it compared to India taxes. So US tax implications on gifts. In general, foreign gift is not taxable if it is received by a US person. You might have seen that US people may be receiving gifts from their relatives or brothers, sisters, or parents. Sometimes old age parents, they say that, okay, we will sell off the dispose the property here and I will gift it to my son in US. So what are the provisions applicable in those cases? So generally speaking, from a non-resident, if a US person is receiving a gift, that is not taxable in US. But there is a reporting requirement, very stringent reporting requirement. The form which need to be filed is the 3520. It's more like a gift tax return disclosing who has given that money to this person and what is the value of the gift. And form 3520 also, it is required to be filed if during the tax year he has received more than 100,000, that is $1 lakh worth of gifts from a non-resident alien individual, not from one individual, it is from all individuals together. If he has received more than $100,000 during the year, then he has to report that gift in form 3520, and this need to be filed separately. And this 1 lakh threshold is not applicable if the gift is from a company or from a partnership firm or from an LLP. If it is other than an individual, then the threshold limit is $16,388 for 2021. If the gift exceeds $16,388 from a non-individual, again form 3520 has to be filed. Again, there are no tax implications. It's just a reporting requirement. So just file form 3520 disclosing all these details. And this is not a return which goes along with the tax return. Though it is filed along with the tax return, there's a separate form and it has to be filed as a separate return, and it has a separate due date as well. So within that due date, please ensure that these gifts are reported. Otherwise, there is a significant penalties for non-reporting of gifts from foreigners in US. Then another thing is the inheritance tax or estate tax in US. Apart from income tax, we have seen state tax, city tax, and estate tax is also there. So estate is basically a tax paid by the estate of a person, estate of a deceased. So who will pay this? Estate will pay. This tax is levied on the estate, but practically the successor who is receiving those assets is the one who discharges this liability. So if the estate belongs to a US citizen, or if a US citizen or a resident dies during the year, his global assets are considered to arrive at the estate tax. But there is a huge basic exemption for this estate tax for a US citizen or a resident, which is $11.7 million, which if you convert to Indian rupees, it may go up to 90 crore rupees. So it's a huge exemption. So only if that exceeds that amount, the excess is liable to estate tax. What is the tax rate applicable? It's at 40%. It may go up to 40%. There are slabs for estate tax as well. So the maximum rate levied on the estate of a person is only if it exceeds $11.7 million is 40%. So by a non-US citizen or a non-resident, say that person is a non-US citizen and he is not also a resident of US, but he holds some assets in the US. For him, the estate tax is to be paid only on US assets. Very cumbersome procedure. Basic exemption of 11.7 million is not available for a non-resident estate. The basic exemption is only $60,000, very small amount. And the tax rates again may go up to 40%, but there is a slab rate. So during COVID, many Indian employees who are holding these stocks which are being allotted to them under ESOP schemes or RSU schemes, they were holding those, but they died. Their estates are, those shares were liable for estate tax in the US, and the legal heir, it is not so easy to release those shares and get in the name of the legal heir. There's very cumbersome procedure where attorney has to come and certify that these taxes have been paid. First the taxes have to be paid, and then attorney has to certify that, then the court probate has to be that procedure has to be followed, and then the shares have to be transferred. So very, very cumbersome procedure. I had 2 cases where I assisted my clients in getting this transfers done. Of course, we will not be able to help them out directly. Indirectly, we can provide all the information and provide support to them. They have to hire an attorney or advocate in the US to complete this entire procedure. Very costly procedures as well. So be cautious, or tell them that if in those cases, at least they have to submit a nomination form. The procedure may become little easy if there is a nomination available, and also if possible, certain demat service providers will allow them to include wife's name as a joint holder for stock option accounts. So you can inform your clients to do this. So at least if there is a joint holder, the process may become little easy. It's not that straight away the money comes to joint holder, but at least the joint holder, the name is already available in the accounts. So the process, at least one step will get eliminated there. So then comes the compliances. Till now we saw various tax implications on various incomes and how those have been determined, then double taxation reliefs and filing status, these things. But now comes the compliances. At a high level, what are the compliances required for a US individual? One is filing the tax return, which is 1040 for a resident return, and for a non-resident return, it is 1040 NR. NR stands for non-resident. So what happens in dual status case? He has two residential statuses in the same year. One is resident and the other one is non-resident status. So he has to file two returns for that year. Whenever he has two statuses, he has to file two returns. One is 1040 and 1040 NR. It is not that these two are separate returns which he will file. Both have to be prepared simultaneously and both go together. It is one return, but both the forms need to be enclosed in the same return. Generally, we see in the year of arrival and in the year of departure. And the rest of the years, it is a 1040 NR, or 1040 full year return. So then comes the W2, which is similar to Form 16 in India. Withholding certificate for wages, which is salary income. Employer will report that salary income in W2, and again one copy will be submitted to IRS, and one copy will be given to the employee, where employee follows the same and report the wages accordingly. Then 1099 interest. This is for interest income. The bank or whoever, the person who is paying interest, will issue 1099 INT at the end of the year. See, here in India, we have Form 16 for salaries and Form 16A for all other income. But in US, they do have a different types of forms. It is nothing but a withholding certificate, which is similar to Form 16A. But 1099 interest is on 1099 INT is for interest, and 1099 DIV is for dividend income. And another form is the 1099B. 1099B is a consolidated form for interest, dividend, and capital gains. There's no separate form prescribed for capital gains. Capital gains has to be reported by the person in 1099B only. So when you look at the 1099B, of course, it is for the entire calendar year. After the end of the year, it is issued, and all transactions which have been carried out during that year will be available in this 1099B. This is nothing but a capital gain statement as well. In India, we get the capital gain statement separately from the Demat account, but in their thing, it is a consolidated certificate which is issued for the entire year. Then for non-residents, there is a separate withholding form called withholding certificate called 1042S. Irrespective of the income, whether it is interest, dividend, or any other income, they will get 1042S only. So when you are filing India return, go through these forms. Sometimes if the income is very small, the person might not have claimed any, might not have filed the tax return, but he has suffered this withholding taxes. You may consider that for FTC for India tax purposes. So you could go through these forms or check with him whether he has received any of these forms, if he has reported any income to you. Then comes the K1. K1 is the partnership income where S Corp or the LLP will issue this K1 to the partners. Based on the K1, they will report the income, partnership income in the tax return and then file the tax return. These are the various due dates and extension. The US also has a separate concept called extension. So let us see what are these procedures. So US tax returns are generally due by 15th April of the subsequent year. So for the tax year 2021, the tax return was due by 15th April 2022. Of course, due to holidays, it was extended till 18th April this year. Otherwise, the general due date is 15th April. There is an automatic extension concept which is available for expat, that is 2 months extension, and the date automatically defers to 15th June. So who is an expat? The person who is not who is living abroad as on 15th April is an expat, not on the vacation or any holiday, but if he is on employment purposes, if he is abroad as on April 15th, so then automatic extension of 2 months is available to him. What generally we see these cases are where deputies, he's been deputed to another country on work permit, or he is on an assignment, long-term assignment to another country. So then he will get an automatic extension of 2 months and his due date shifts to 15th June. No need to file any separate form. There is another extension called 6 months extension, which is available to all taxpayers. So from before 15th April, he has to file this extension form called 4868. So automatically his date gets deferred to 15th October. So beyond 15th October, are there any extensions? Extensions are available provided, as we already discussed, there is a concept of elections where certain conditions have to be met. So if the person has to meet certain conditions in the subsequent year, till then he will get that extension, and post meeting those conditions, he can file the tax return by availing those elections. Then what are the benefits of filing this extension? Late payment interest and late payment penalty both are waived till the extended due date, which is 15th October. If you are not filing this extension, then both are applicable, and in addition to that, late filing penalty is also applicable. Sorry, see, late payment interest and late payment penalty are applicable till the date it is extended, that is 15th October. Only late filing penalty is not applicable if the extension is filed. Late filing penalty is nothing but 234A. Late payment penalty is nothing but 234B. We can just similar to these things. There is a concept in US as well. So interest and penalty are applicable if there are taxes due, even though extension is filed. But you can estimate the taxes and pay it along with the 4868 form, that is at the time of filing the extension. In those cases, interest is not levied because anyway you have filed you have paid the taxes, so only the return can be filed at a later date. Yeah, this is another draconian provision in the US tax laws for individuals. So it is called passive foreign investment company. So basically, what are these? See, to qualify as a passive foreign investment company, the two tests are, any of these two tests have to be met, which is income test and asset test. So when the foreign corporation or a fund or investment is meeting these tests, any of these tests, then it is considered as a PFIC, which is passive foreign investment company. For all foreign corporations, funds or investments meeting the following tests are PFICs. So first one is the 75% income test. So what is this test? An entity or fund would be treated as PFIC provided 75% or more of its income is passive income. So in India, if you see the mutual funds, 100% of that income is the passive income. Either it will receive interest or dividend or capital gains. So all are passive income. So more than 75% is passive. So it is straight away qualifies as PFIC. So another is 50% asset test. For assets, it is 50%. For income, it is 75%. So if an entity or a fund is treated as PFIC, if a minimum of 50% of your assets produced are passive income, or such assets have been held with an intention to produce passive income. So this 50%, if the company has only real estate income, it is only rental income. So you apply this test. If all properties are let out, sorry, and entire income is only the rental income, then obviously that company is considered as a PFIC. So all investments in Indian mutual funds or alternate investment funds or exchange traded funds, all these funds are PFICs. It meets either of the income test or asset test, or most of the these funds meet both the tests. So if I am a mutual fund investee in India or investor in India, so if I have invested, if I am a US citizen or a green card holder or a resident of US, and if I have invested in Indian mutual funds or alternate investment funds, then PFIC regulations are triggered. So what are these regulations? Implications of investing in a PFIC. High tax rates. Depending on the method of accounting chosen by the taxpayer, the tax rate may add up to more than 50%. So you can imagine, I mean, the calculation is very cumbersome. The tax rate may go beyond 50% plus 3.8% of investment income, and those things are there. Then capital gains are not eligible for preferential rates, and it will be treated as a regular income. So whatever we discussed for the long-term capital gains, which is 15% or 20% or 0%, that's not applicable if the gain is from a PFIC investment. That goes as a normal income. So this is from the tax rates perspective. Then there is a complex reporting as well. Form 8621 need to be filed, and for each and every PFIC, one 8621 needs to be filed. So if he has invested in 10 different mutual funds in India, then he has to file 10 8621 forms in US. And the same mutual fund, if he has invested in different dates, then those many 8621s need to be filed. Say for example, SIP, the person who is investing under systematic investment plan, if he has invested every month in 5 different mutual funds, total 8621s which he has to file is 60, because each and every month he will have investment and he has different mutual funds. So his reporting will be very bulky. So elections can be made if anything need to be elections made if any with respect to taxability. Those things also have to be reported in Form 8621, and it needs to be completed every year. It is not that only in the year of investment. Every year you have to file Form 8621 to all your investments which qualifies as PFIC. So I had one case where his entire tax return, US tax return, if you see, it is 600 pages. Out of that, 500 pages are PFIC reporting. Only 100 pages is the normal return. So the reporting may become such a complex thing that it is a huge, it may throw a huge implications on the taxpayer. And what is the exposure? IRS does not have any limitation period for tax audit, which is scrutiny assessment, if the person is investing in a PFIC. So generally speaking, they do have 3 years limitation, or if the income which has been escaped is significant, then it is 6 years. So these 3 years and 6 years are not applicable in the case of a PFIC reportee. So PFIC investor. So there is no limitation period, and IRS can go to any number of years, irrespective for his lifetime also. They can go back and ask queries about the thing. So somehow IRS has a different feeling when it comes to PFIC. If the person is investing it through these kind of mutual funds or through PFIC companies, somehow IRS sees this as a huge non-compliance, or there is a huge tax evasion objective. That is why these kind of stringent rules are implemented for PFIC reporting. Then what is the valuation or accounting method? How do I compute PFIC income? There is mark-to-market election. Nothing but on the date of on 31st December, I look at the PFIC investment. If my investment is 100 and the market value has become 110, I just go ahead and report $10 in the US return. That is my income. That is mark-to-market election. And if there is a the value has gone down, then the loss can be considered as a capital losses and can be offset with the capital losses rules are applicable under mark-to-market election. So in the next year, what happens? Whatever I have considered as an income, that is 110 will be my opening balance, and if the cost has become 120, then the balance 10 again I will report as a PFIC income in the subsequent year. So another method is the qualified electing fund. So for qualified electing fund, there is there has to be a statement given by the foreign PFIC indicating the share of profit and share of income for that particular investor, which is generally practically not feasible for a foreign companies to follow US accounts and then issue this statement. So practically, I have not come across with qualified electing fund in any of the individual's case. Then comes section 1291 fund. 1291 fund election is again taxable only in the year of distribution. Generally, under mark-to-market election, though there is no realization, it is taxable. Whereas section 1291, under section 1291 fund method, if you are following, only if there is a distribution or a realization of the asset, you will go ahead and report that, provided the distribution is more than 125% of the last 3 prior years distributions. So this is all about PFIC, very stringent rules. Then comes the foreign bank account reporting. Similar to what we have here, foreign asset reporting, US has both foreign bank account reporting and foreign asset reporting, and these two are two different reporting. It's not the same reporting. So foreign bank account reporting applies to a US citizen or resident. If you are a non-resident in US, even though you have bank accounts in US or abroad, there is no requirement to report those bank accounts. But if you are a US citizen or resident, all foreign bank accounts to whichever country you have to prepare a return called FBAR return and submit that to the Treasury Department. This is not to the IRS. This is a separate return which goes to Treasury Department, and this is also due on April 15th. By April 15th, you need to file this return. Having financial accounts or signatory authority. Say suppose sometimes what happens is these US citizens or expats, they are directors or CEOs of Indian companies where they have a signatory authority for Indian bank accounts. So even though they do not hold bank accounts in their name, because they are signatory authorities, even those bank accounts have to be reported in US. So US also has given a small threshold amount, which is $10,000. Only if the balance exceeds $10,000 in all the foreign bank accounts put together, then only the reporting comes. It's not the each and individual bank account. All bank accounts put together, it should exceed $10,000 at any time during the year. As on 31st December, it may be lower, but during the year at any point in time, if it is more than $10,000, the reporting kicks in. And these accounts, this is not just limited to bank accounts, all financial accounts like say demat accounts, brokerage accounts, your insurance policies, current account, savings account, time deposits, all these deposit accounts need to be reported under FBAR. And maximum values in the relevant accounts during the tax year need to be considered for determining the threshold as well as reporting. This $10,000 have to be determined the maximum balance which is available at any time during the year, both for reporting purpose as well as to determine whether the applicability of FBAR reporting. And in case of joint accounts, both spouses must comply with FBAR separately. There is no married filing joint or married filing separately here. Each individual has to file a separate return. And if FBAR compliances are not met, there is a penalty of $10,000 which can be levied by the US Treasury Department. Then comes the foreign asset reporting. Now we saw foreign bank account reporting. This is a foreign asset reporting. There is a little duplication between these two, but anyway, these two are different forms which goes to two different authorities. FBAR goes to Treasury Department, 8938 goes to IRS. So both these are mandatory provided those conditions you satisfy. So again, this is applicable to US citizens and residents. Non-residents are not no need to comply with Form 8938, and if they meet the reporting thresholds as discussed here. So married filing jointly, if you are filing total value of assets, if it is more than $100,000 on the last day of the tax year, or more than $150,000 at any time during the year, then you have to file Form 8938. If you are filing married filing separate, 50%, that is $50,000 and $75,000 is the limit. So if your financial accounts, all financial accounts put together, if it is more than these amounts, then only Form 8938 come into picture. This form need not be filed separately. This need to be attached to the 1040 or 1040. Of course, 1040 NR cases, this does not apply, along with Form 1040. The amounts need to be reported in US dollar. You need to convert the foreign currency using the end of the taxable year exchange rate. So where do you get these exchange rates? IRS publishes exchange rates for different countries, and even if you go to IRS website, you can look at the exchange rates, and by applying those exchange rates, you need to convert this foreign currency to US dollar. And as on 31st December, the reporting comes in, whereas to determine the threshold as well as reporting, you have to look at the thresholds maximum values at any time during the tax year and not at the end of the year. And in an illustrative list of financial assets are all kind of, again, the bank accounts, brokerage accounts, pensions, shares, mutual funds, bonds, everything need to be reported. Again, it is only financial assets. Non-financial assets like jewelry or land and buildings, that need not be reported. So what is the difference between FBAR and foreign asset reporting is, under FBAR, if you go to the investment accounts, I'll just disclose demat account and the balance of all the shares which I am holding in the demat account, the balance. But under foreign asset reporting, you have to list down the different shares or mutual funds, and accordingly the balances need to be given. Again, non-compliance with 8938 attracts significant penalty implications. So please comply with this without fail. Then comes W8-BEN. W8-BEN is a form which need to be filed by a non-resident of US if he is availing the treaty relief. See, in India, what we do, we submit this if for TRC or this 10F for availing the lower deduction, or there is to avail the treaty benefit. But in US, you have to provide W8-BEN. Either you are claiming the treaty exemption or you are claiming the treaty benefit, that is reduced tax rate for withholding or claiming exemption. So by providing W8 Ben, the US person who is paying the income to you has to apply the treaty rates or treaty provisions. If it is exempt, then he will not deduct anything. But if there is a taxability as per the treaty, then he will withhold the rate as prescribed by the treaty. Again, for this purpose, it specifically asks which country's resident you are. So you have to determine the residency as per treaty, not as per the domestic tax laws. So generally Article 4 of the treaty, which gives various provisions as to how to determine the treaty residency. So that needs to be applied, and then treaty residency need to be determined, and you have to disclose to which country's resident you are. Then resident country and treaty article also to be specified, which article benefit you are availing. So this does not apply to US citizen or resident aliens, that is green card holders, because they are US residents. So only non-residents has to submit W8 Ben. Then ITIN, individual tax identification number. So what is ITIN? See, if an individual is not eligible to get SSN, then he has to apply for ITIN. Without ITIN or SSN, he will not be able to file the tax return. Similar to Aadhaar or PAN in India, without that we will not be able to file. There also, without SSN or ITIN, you cannot file the tax return. And not all people are eligible to get SSN. Example, spouses of people who are going on L1 visa or H1B visa, sometimes they won't get SSN, so they have to apply for ITIN and then disclose that and then file the return. Similarly, dependent children, if they are not born in US, the SSN is not available to them, so they have to go for ITIN. And ITIN can be applied from India as well. So there's a separate procedure which you are applying it from the foreign country. So that need to be complied with. So then comes the challenges. So as I explained, when you look from India perspective, US has many challenges. So I have picked up these three different incomes which we come across while preparing the India tax return, and how do we deal with these incomes while reporting in India return. One is K1. K1 is a pass-through for US purpose. What we saw was it's a complete pass-through. So partnership level, there is no taxability, but at the partner level, he will take the K1 and he report that as his income and pay the tax in US. But in India, what happens? The income at the partnership level is taxable, but whereas in the hands of the partner, it is completely exempt. So when will you report this K1 income? Is this K1 income taxable first of all in India if he is a US resident? I mean, if he is an India resident where global income is taxable in India. View 1 is, yes, this is taxable, and consider the same K1 pass through, the partnership as pass through, and report that income in India, and whatever the taxes has been paid by the US citizen or a green card holder, claim that as a foreign tax credit in India. View 2 is, no, that is this is a partnership where the partnership is taxable. So only distributions are taxable. If there is just a pass through, only the reporting purposes if K1 is issued, and if there is no distribution from the partnership, the income is not taxable in India, especially in the case of S-Corp. S-Corps are basically treated as a company. So the second view holds good in case of S-Corps, because when there is a distribution, I'll treat that as a dividend income and I will tax it in India. But in the case of LLPs or other partnerships, in my view, view 1 is better. You treat that as a pass through and report that income so that you can avail the FTC also in the same year. But if you are treating that as going by the view 2, if you are taking the distribution is taxable, you will not tax that K1 income at all during that year. You will go to distributions, and in the year of distributions you may tax, but he may not get the benefit of full foreign tax credit at that point in time. So US also has an individual retirement account. These are nothing but a PF, which is similar to PF. They do have individual retirement accounts. So they also have a 401k account. 401k acts more like an NPS, whereas individual retirement accounts acts as a PF. So recently there was a challenge with respect to these, because it was the income from these accounts were not taxed in US till their retirement. These can be withdrawn at the time of retirement in US, and the taxability used to arise only at that point in time. So we used to, if the person is an Indian resident, we used to see a lot of gap. I mean, for US purposes, the income is not taxable. So for India purposes, what do I do? Because he's a resident, global income is taxable in India. Thankfully, the last year, Finance Act 2021 they introduced, they said that they will come out with the clear guidelines. So now recently the notification is also released, which says that foreign retirement accounts in case of specified countries can be taxed at the time of withdrawal on a cash basis, not on accrual basis. So taking a shelter under that. So for US is one of the countries which is notified. They have notified 2 countries so far. One is US and the other one is UK. So since US is notified, we can treat these retirement accounts as notified accounts, and then you can take the taxation till the time of withdrawal. So every year you need not you need not look at the 401k statement or IRA account and then see what is the income accrued. But there's a specific form which you need to file, which is Form 10EE, which need to be filed in India if the person has any income from these accounts. Then comes the other challenges. So one major challenge which we see is the fiscal year versus calendar year. All reporting, US tax return, everything will be on the calendar year basis, which is Jan to December. Take an example of 2021, 22 for India. So India follows fiscal year. One is how to determine the income. Shall I go with the return and just take year on year as per calendar year? I'll report it for fiscal year. Many people follow that approach, but in my view, that is an incorrect approach. So if you are following fiscal year for India, it is April to March. Get the statements for April to March. Take, for example, W2. Get the pay slips for April to March period and determine the taxable salary, and you consider that. Do not go by the W2, which is there for the calendar year. Similarly, for interest and dividends also, you can go through the statements. 1099B, which I said, the consolidated statements, it gives with the dates. So you can take the April to December period from 1099B. Then for the rest of the months, you can ask for the statements from the fund house, which gives monthly statement, income statement. So based on that, you consider for the fiscal year purpose, which is April to March. Then comes exempt income like PF, PPF, which is exempt for India purpose. So if he is a US citizen or a green card holder or a resident, whether this is taxable in India, yes, it is completely taxable. There is no specific exemption available in US tax laws for foreign retirement accounts. So any interest received on PPF or PF is going to be taxed in US. So then comes capital gain distributions. We saw capital gain distributions. What are this? These are the capital gains of mutual fund houses, which is given as a capital gain distribution, and that is taxed as a long-term capital gain for US tax purposes. So whether I treat that as a dividend or capital gain, when you look in substance, by applying Indian laws, if you apply to that mutual fund house, these are in the nature of dividends, because it is nothing but a profit made by the mutual fund, and that has been distributed to the holder or a member, which is need to be in the nature of dividend. But US treats that as a capital gains. So whether I treat that as a capital gain or dividend, because the tax rates are different in India for these two incomes. In my view, on a conservative basis, you can treat that as a dividend. But sometimes what happens is, even I have clients where they insist me to treat that as a capital gain. So it is not an incorrect position, but it is a gray area. So caveat with appropriate caveats to your client, you may consider that as a capital gain. But if the income tax authorities issues a notice, they may not agree that it is in the nature of capital gain. Then comes the double taxation avoidance agreement saving clause. So we already see how to mitigate that. That is, there is a domestic law provisions, and based on that, the FTC or foreign and income exclusion is available to them. So then comes the state taxes, city taxes. Many of the states levies income tax, and city also levies income tax. Can I consider that for foreign tax credit purposes in India? $1 million question. So, I mean, we have seen Wipro, where Karnataka High Court held that under Section 91, where there is no treaty, under Section 91, FTC is, can be availed. I think even in the case of Tata Sons, Delhi High Court also held the same thing. Now the matter is before Supreme Court to decide. So we need to wait and watch till then. However, if the assessee's jurisdiction is in Karnataka, maybe relying on the Karnataka High Court decision, by putting proper caveats to the client, you may avail FTC for state taxes and city taxes as well, since we have blessings from Karnataka High Court in the case of Wipro. Then US citizens and green card holders, US citizens, if they are working in India, for PF purposes, they need to be treated as international workers. So special provisions are applicable for international workers where the contributions have to be made on the gross salary, not only on basic, or I would say that basic plus special elements. So there's a lot of non-compliance from the company side as well. If you have any clients where there are foreign nationals working, not only US citizens, any foreign national for that matter, if he is working for Indian entity, you can check whether the PF compliances are properly done or not. So I thought understanding a US tax return may be a better thing, just to give you an idea. So you can see here, this is a 2020 US return, and filing status, you have to choose which one you want. This is single, married filing, joint, married filing separate, head of household, and qualifying widower. So whichever qualifies, whichever category you qualify for, you need to choose that. You need to give all the general details here. So this is the income part of it. See here the qualified dividends, 36,381, and in this case he has 37,743 is the total dividend income. This includes qualified dividends, which is taxed at a special rate. So his total income is 362,571. Let's see his total taxes. See, here is the tax, but he has got a credit of 2,000 child tax credit. So his net tax is 72,504. So if you want to claim FTC on US income, say suppose the wages are taxable in India, this 239,488. If I am claiming FTC on 239,488, how will I arrive at the US tax rate? I will take the tax amount divided by the total income amount, and then you will arrive at the average tax rate. Then see whether that tax is more than or less than India and apply take the FTC on that. Lower of those two you have to apply and avail the FTC. And can you apply this for dividend income of 37,743 if that person is resident in India? Definitely no, because we have already seen qualified dividends are taxed at special rates, which may range between 0, 15% or 20%. So how will I find out the tax rate for qualified dividends on capital gains? If there is a qualified dividend on capital gains, this is the form which will be filed along with the form 1040. So here you can look into what rate the income has been taxed. See here, multiply line 17 by 15%. If this line item is there, then this is taxed at the rate of 15%. So if it is 20%, there is a line item for 20% also. So you look at this sheet and determine the tax rates applicable for your qualified dividends or capital gains. Then you take the FTC accordingly. See, in this case, 3,000 is the capital loss offset with other income. He did not have any capital gains during the year. So this 3,000 carryover losses, $3,000 has been offset with other income. So this is a table for this person. These are the tax rates. See, rental income, India tax rate is 34.48. So when you look at interest income, India rate is 34.48, whereas US tax rate is 29.56. Lower of these two is 0.2956. So the FTC is available at the rate of 0.2956, 29.5% basically. So then others, dividends, though it is qualified for US purposes, in India it is entire thing is dividend income, which is not a qualified dividend. So 34% or 29%, whichever is lower, I have applied that. So then comes the opportunities for Indian chartered accountants. What are the opportunities? One is US tax preparation or writing. For US tax preparation, of course, you need to be aware of the technical concepts of US taxes, unless any company is giving that as an outsourcing. But definitely you can see whether there are any opportunities from US CPA firms to take this business as an outsourcing business and start doing that. That is one opportunity. Then FBAR, preparation of FBAR is much more simpler as compared to preparation of tax return. It is very straightforward form. You can just go on filling that. So if you really want to provide FBAR services for your clients, you can just go do some research, discuss with me if you're really interested. Then FBAR reporting, it can be done from India and you can charge a nominal amount for that. Then comes the bookkeeping. See, for high net worth individuals, when I see, it is not that easy to pull the data between this fiscal years and calendar years, especially when they have huge investments both in India and abroad. It is always advisable to maintain their books of accounts in a crystal clear manner. So when a US CPA asks, you can just run the report from your accounting software for calendar year basis and give it to him. And for India purpose, you can take the fiscal year basis. So that is one opportunity. If you have any high net worth individual client, instead of spending so much time at the time of preparing the tax return, you could offer him a bookkeeping services, and you can prepare his individual accounts in accounting softwares, and then accordingly make the process smoother. So definitely you can charge for that. And another thing is, especially in case of HNS, what I have seen is coordination or sharing of information. Host of information, lot of information need to be shared. Whatever we have from Indian thing with the US CPA, because they need in a specific format. As we discussed, there are different reporting requirements like PFAQ, or there is another concept called controlled foreign corporation, CFC. So significant information is required, and they insist on specified formats. So if you are sharing that information in those formats, or you are spending significant amount of time, please convince the client that the amount of time you are spending, and charge that on a maybe hourly basis or a fixed fee, whatever is appropriate. You can discuss with the clients and take that. Then comes the advisory. Advisory, of course, again, you will have you need to have a technical knowledge. PFAQ, I have given many advisories on PFAQ. Then gift and estate tax, as I mentioned, I handled 2 cases where estate tax was applicable for a non-resident, and I worked with the US attorney and get the assets transferred in their names. Then from a succession perspective also, when he has both US and India, succession is also not that easy. When you look into the preparation of a will or anything, that is country specific civil laws are applicable. For US assets, I cannot, US and India assets both together, a person cannot execute one will. So educating him more on the succession and helping him on the succession planning is another area which you really can focus on. So that's all from my side. If there are any questions. I think there are a couple of questions popped up. Sripat, can you see any questions?
In the Q&A section, actually, I cannot see any.
Oh, okay, one moment.
Chat sections.
Let me stop sharing. I think then I will get that. Yeah. I think it is part of chat box. Yeah, I have one question. I can see one question here. Okay. Please allow me. Okay. Fiscal year for tax purpose is also followed. For tax purpose, no, US follows only calendar year. The fiscal year concept is available for corporations and trusts, but not for individuals. So for individuals, they have to necessarily follow only the calendar year reporting. Can MFJ option be elected after legal separation? No, after legal separation, there cannot be MFJ cannot be opted, because as on 31st, 31st December, if the person is remarried, again married, yes, he can opt for married filing joint. But if he is not married, then he cannot opt for it. He has to go for single, not even married filing separate. Then, if a person enters the US in June and stays till the end of the year, does he become resident from June or after crossing the threshold days of stay? No, once he, see, as on 31st December, you need to see how many number of days he is in US. But once he crosses the number of days, then from the first day of arrival, he will become a resident. It is not that after completing 183 days, he will become a resident. See, in your example, if he is going in June, from June 1st onwards, he will become a resident, since he is meeting that 183 days presence test. There are two additional questions from Mr. Sachin Kumar. Yeah. Should I read it out? No, I will only read it out. I can see that. One of my clients who have received order for supply of goods have been requested by the USA customer to fill up
8 Ben E. Is this required to be provided? Why is it being asked when the order is only for supply of goods? See, generally for supply of goods, yeah, there could be, see, if there is a PE, that is Indian company has a, or the Indian buyer has a PE in US, then the withholding implications may differ. Also, treaty implications also may differ depending on the permanent establishment status and other things. So, in order to establish whether you have a presence in US, business presence in US or not, he might be asking for the W8 Ben E. Again, please submit that so that he won't withhold anything. So otherwise, withholding implications may arise. Check with them properly. Husband is US citizen and wife is Indian citizen, filing taxes in US jointly. After demise of husband, wife need to file single return. Yes, after the demise of husband, wife has to file single return if she has any income from US sources. And if she is not a resident of US, she can file a non-resident return. But if she is a resident, then she has to file a full year, 1040 return. US citizens' medical treatment expenses incurred in India. Do we get standard deduction or itemized deductions for such expenses? US citizens' medical treatment expenses incurred by India, I'm presuming that maybe employer might have incurred this. So if he is reporting this as wages in W2, yes, it has to go as taxable. But in India, yes, if it is again treated as a perquisite and reported in Form 16, yes, you will get a standard deduction in India. In US, yes, if it is treated as taxable wages for US purposes, again, he can optimize between standard deduction and itemized deduction, provided he is a resident. But if he is a non-resident, then he cannot go for standard deduction. It's only itemized deductions. What are the consequences of incorrect claim of deduction for 401k investment? See, you need to reverse the incorrect claim. Maybe if there is an opportunity for you to revise the prior year returns, please do that. And also there is an option for employer to issue a W2C, which is W2C corrected form, which is a amended W2. So based on that, you can revise your tax return as well. And that is the best approach. If that approach is not possible, then maybe you can try reducing the current year or increasing the current year salary income for that claim of 401k investment. Okay, I think all questions are answered now. Any more questions? Any questions here? You have? Yeah, please. Oh, offline. Okay.
Sir, I think another one question has come on that.
Yeah. Yeah, somehow I'm not able to see those questions. No, those are coming to you, Sripa.
No, just a minute. I'll read it out if that's okay.
Yeah. Please read it out. Yeah.
So the question is from Lakshmi Devanand. It says rental income in case of property not let out, can the mortgage interest and property tax be, just a minute. Yeah. Rental income in case of property not let out, can the mortgage interest and property tax can be set off against other head to a max of $3,000 or $1,500?
No, see, the $3,000 and $1,500 limit is applicable for capital gains, not for rental income. So, say, you're saying that there is no rental income, but my question is the property available for rent during the year? So, if the property is available for rent during the year, but due to non-availability of tenant, if there is no rental income, then you have to claim that as a rental expenses only, both property taxes and mortgage interest. But if the property is not at all available for rent, if it is used as a principal residence, then there is no deduction available for him. But mortgage interest payment can be claimed as a deduction under itemized deduction, that is Schedule A, not as a under Schedule E, rental income. Yes, Sripad. Next question.
There is also another question from Lakshmi Dev. Can you please explain what is passive income with respect to PFIC?
Huh. So passive income there is nothing but the non-earned income. Basically, earned income means where you put your efforts and earn that income. Salaries is one example. Self-employed income is another example. But for passive income, most of all other income goes as a passive income only. Best examples are interest, dividends, and capital gains income. So you need to see whether PFIC has these incomes, the Indian company or the foreign company. If that company has these incomes, that may become PFIC if they meet that asset or income test.
And Ashish Agarwal is asking website from where we can get the updates on US tax laws.
US tax updates or any material on US tax laws, if you want, the best website is irs.gov.in, which is a US government department income tax website like CBDT. And the another special feature of US is for each and everything you have publications, whether you take PFIC or control foreign corporations or foreign partnerships, there is a publication available, and the best thing to read those publications. Of course, they are very lengthy, I agree, but if you need a correct information, please go through those publications and they are available for free.
Yes. Sir, a few of the participants are asking your details, how they can reach out to you.
Okay, I just need to share my screen. Sorry? Okay, yeah. Okay. Yeah, these are my credentials. These are my email ID and phone number. So anyone wants to reach out to me, you can contact me with these details.
Sure. Amarnath sir, I think this was really a wonderful session. There were a lot of appreciations from the participants, as also in the chat. So thank you so much for your valuable time, and thank you for sharing your knowledge with all of us.
Oh, thank you, Sripad. Again, I would like to thank Bangalore chapter for giving me an opportunity to share my views on this. And also I would like to thank participants wholeheartedly. Yeah, I'm very glad that I have got this opportunity to share my knowledge on this topic. Thank you.
Thank you, sir. Thank you. So nice of you. Thank you so much. Thank you, participants. Thank you.